Good afternoon, everybody. Welcome to Mecardo's very first webinar. We're still waiting for a few people to log on, but we've got a bit of housekeeping and a bit of background, so I thought we might just get started. We're excited to now offer webinars as part of our Mecardo service to provide our subscribers and others with regular updates on the markets and on specific topics. My name is Jenny Ann Hall, for those of you who don't know. I'm the Business Development Manager for Mecardo, and I'm going to be facilitating the webinar today. For those of you who haven't seen Mecardo before, we're an online service providing analysis and commentary for livestock, wool and grain markets. There's an enormous amount of fantastic market information provided by MLA and others, and with Mecardo we aim to value add that information by filtering what's important, by analysing it, and by delivering what's relevant without the need for people to go and sift through the range of info. In particular, we focus on the market outlook and what analysis actually means for producers. We rely heavily on MLA information to be able to provide what we do. And with that in mind, we're very pleased to have Tim McRae, MLA's Chief Economist, here today to present the key findings of their mid-year update to their 5-year industry projections for cattle. For those of you who don't know, MLA produces these projections each year in January and updates them about this time each year. Following Tim, Rob Herrmann will then take a look at what these projections might likely mean for the market outlook and price. Rob is Managing Director of Ag Concepts Unlimited, which is an independent risk advisory and market information service, and Mecardo is a product of Ag Concepts. Now, before we get going, there's just a bit of housekeeping that I wanted to outline to you. We'll have 15 minutes question time at the end. If we don't get through all the questions, we'll be recording those questions, and we'll get back to you and deal with them via email outside of the webinar. Because of the large number of participants that we've got on the line today, your phone's been muted to make sure that we keep the quality of the audio high. You can use your chat box at the bottom left of your screen at any time during the webinar to put forward questions. I'll collate these as we go and then direct them to Tim and Rob at the end. Now, just to make sure, make sure you can ask questions if you need to, I would ask you all to please go to your chat box at the bottom left of your screen, and it's next to a little cog. There's a big box, and then below that there's a cog with a line, a white field. Could you please just go in there and each of you just type your postcode? That'd be great. And just to be aware that chat is only seen by us. It's not seen by everybody else on the call. Okay, thanks. It looks like everybody's got it sorted. There's going to be a short 1 to 2 minute survey at the end of the webinar, which we'll use just to continually improve our webinar service. We'd appreciate you remaining online for this. It'll just take a minute, as the feedback really will help us to continue to make sure that we offer something that you guys value. If you have any technical issues, you can contact Redback Conferencing, who are the webinar provider, directly at any time by pressing *0 on your phone. And on the screen there's also a Sydney number if you have difficulties getting onto the call. Without any further delay, I'd like to hand over to Tim.
I'll give this a go, but thank you firstly to Mecardo for the invitation to present. We do them, as we said, every 6 months, and one of the issues we have with our projections are very general. They look at a national herd and a national export outlook, but to have someone able to give the analysis further down for producers and what is certainly welcome. I think I'll start off with looking at the supply side of the Australian cattle industry, because really that's where our big focus has been for the last 24 months. It's certainly been the main drama, I think you could say, around cattle returns. The cattle that's come to the market over the last 24 months has been drought related and coming from a very big cattle herd. So the map there you can all see, it's probably no surprise to everyone that, it's really been a very tough 24-month period for the Australian cattle industry, particularly that it's based, the majority of those cattle are where the drought's been. The fear of El Nino I'll talk about right at the end of the projections, but I just wanted to underline that, this supply that we've seen over the last 24 months has been drought-related. And it would have been very interesting to see and would have been the most palatable scenario had we seen some average seasons, particularly after the two very wet seasons that we had. I'm just getting some comments that you're having some trouble hearing me, so someone has said speak louder, so I'll do my best there. Look, the big factor that we're looking at, and it plays into a significant reduction of cattle coming into the system in years ahead, has been a very high Australian female cattle slaughter over the last 24 months. If everyone can remember, we had those very wet years of 10 and 11, where roof stocking was the go word, and we saw some cattle prices react to that. But really in the last 24 months, female turn-off has been very high, and that's really led to a significant reduction in the cattle herd where we are currently. Still into 2014, when we did our projections in January, we would have thought this very high slaughter would have started to decline into 2014, but if anything, it's actually increased. And I think that shows...
Am I outside the conference call?
Shows the extent of I'm hoping everyone can hear me because I am hearing there's a bit of background noise and such, but 2014 we really would have thought numbers would have started to come back. But the extension of this drought, and I think it also shows the cash flow and the debt issues a lot of producers have been facing, have had little option to just turn off stock.
So, look, I might just recap very quickly for those who are having noise issues. I assume I'm right to go, Jenny Ann? But really, the issue that the cattle industry is facing right at the moment is when will this supply of cattle stop? On top of that, the big surge has been in females. So this year we're looking at back-to-back years of 8.3 million head of adult cattle slaughtered, which just means, if you want it effectively, 2013 we are just making a bigger supply hole as soon as this big surge of cattle decides to finally halt. Add to that we've had massive live export turn-off numbers in 2014 and 2015. We are really eroding our supply and productive capacity for years ahead. Right at the very moment, we think the Australian cattle herd stands at about 26.7 million head. We reached just over 29 million head about 18 months ago, which we did see some build-up through those wet years. We also saw some inventory held over due to the live export issues. But, overall, the herd is in rapid decline at the moment, and that's really no surprise when you've seen the slaughter numbers that we have for the last 24 months. We expect to see the herd fall to a low of about 26.1 million head in 12 months' time. However, it should be pointed out that if we do see dry conditions continue, and it would be very unprecedented to see a third failed wet season, we could very well see the Australian cattle herd drop below 26 million head, which would make a very, very tight herd. When we look at where the herd decline's been across the cattle regions, not surprisingly, the major decline has been in northern New South Wales and throughout Queensland with those drought conditions. What's been very interesting to note as well is slaughter numbers in the south have also been quite high, or much higher than we would expect, given reports of the best autumn in 30 years in some places and what started out to be a wet winter. But I think what we're seeing there is producers are still very tight on the cash flow side of things. Direct-to-works prices have been encouraging, particularly for well-finished stock. So we're seeing those southern numbers also decline. But for those that can see there, that northern growth has really been crimped, and we don't expect to see that growth until 2016. Again, that'll create a lot of supply pressure through the cattle industry in the north, whereas in the south, we expect the herd to increase slightly. But again, the competition from other commodities, whether it's prime lamb, wool, cropping, will continue to keep the cattle herd under pressure. However, when we look at the slaughter, and it's been so high for so long now, that we do expect some year-on-year declines to come for both production and total slaughter in the final quarter of this year, hopefully also associated with a wet season kicking in through November and December. So whilst we do expect to see high numbers continue and we compare them year-on-year, we'll start to see some decline, and that will be an indication, particularly for 2015, that we start to see some bigger declines in the numbers. So overall on the supply side, we're expecting things to get tight. It's just a matter of when they will get tight. But certainly the cattle herd is in very quick decline, and that's going to cause some very big issues for the supply of all our export markets in years to come. And that leads me on to the demand side of the equation, which looks very positive for the years ahead. So currently Australian beef and veal exports are at record levels. In the last 12 months, we've had 7 months that have exceeded 100,000 tonnes of beef shipments. Our previous record before that, our highest ever month, was 94,500 tonnes in 2006. So it just shows how strong our export volumes have been. Yes, underpinned by the very high slaughter volumes, but also, there is a growing markets out there for Australian beef. There has been a global increase in beef prices. It just hasn't been felt back here to Australian producers because of that supply issue over the last 24 months. We have continued to see production as a percentage of exports as a percentage of production increase. So there's no doubt that we still think demand for our beef globally will be very high, even if we see a contraction in supplies in the next 12 months. We're looking at about 70% of all beef in Australia produced is exported. When you put on top of that over 1 million head of live cattle, our dependence on those export markets is becoming greater as the years go by. When we have a look at the Australian market, now again, it's taking 30% of our beef production, our most valuable market, no currency issues, no market access issues. We expect it to be one of the markets that will really feel the pinch of this much tighter beef production in the years to come. It has a big pool of beef to pull from, but particularly if we see the dollar head in the directions that it is meant to, hopefully below 90 cents, it'd be even better if it's below 80 cents in the coming years. Now, we expect the domestic market to really feel some pressure there. And when you look at the Australian beef market over the last, on a 12-month rolling average, the red line shows the percentage of beef production utilised in the domestic market. As exports have increased, the amount of beef that is able to remain or be attracted by the Australian market has been declining, and we certainly think when there's a big decline in production, that this domestic market is certainly going to feel a pinch and probably result in some retail, increase in retail prices. We go to our largest export market, or what was our largest export market as of a couple of weeks ago, to Japan. And really the big impact we're seeing there is a decline in the demand for what we would all view as very top quality beef. Chilled grain-fed and chilled grass-fed beef demand has fallen significantly in the last 10 years. I think it's something that's wiped over $1 billion of export returns from the Australian market. So there is an indication of where some of that value for that top-end product has gone. But even though we've just signed an FTA with Japan, we still think this will be a market that comes under increasing pressure, particularly if demand from China stays strong. The US market is now our largest export market for beef as of the end of the 2013-14 fiscal year. It's the first time it's been this since 2013, but as you can see on the chart, we nearly shipped over 400,000 tonnes of beef to the US back in 2001. Now, if we were looking at quotas to come in to control those volumes, it does help that the dollar was at 50 cents back then or lower. But the US is now our largest market, predominantly taking lower valued product, manufacturing beef. So on value terms, Japan still leads it. But what's attracting all this beef to the US recently is record prices right through the US industry from gate to plate. But particularly for imported beef, they're attracting a lot more Aussie beef because the return for that product has never been better, even with a dollar up around 93, 94 cents. And you can see there that, it's really been a sustained rally in this export price, this import price in the US, which is very much a proxy for global prices. And we're seeing a lot of beef, a lot of Australian beef flood back into the US, which we expect to continue. Also, I should point out for the US that it has significantly increased the amount of cuts meat that it takes. And this is certainly a combination of both the trend towards pasture-fed and natural beef, if you like, and Australia's ability to have accreditation systems to meet that, but also growing demand in those markets for that product. 31% of all beef exports sent to the US last year was of cuts, and that's where we're seeing some real increase in value to that market. And we expect that to continue, and certainly we've seen some move by the industry to actually have accreditation standards to meet that demand. Just on a couple of markets, Korea, a market that very much flies under the radar, but again, we've signed an FTA with Korea that'll at least help us, hopefully, not lose any more distance on the US, our great competitor there. But again, here's a market that has about 50% of all consumption is from its own domestic herd, and they have a very big cattle herd at the moment, so we are watching there about their own beef production ability increasing and impacting import demand. China. Now, I'll spend a bit of time on China because just this morning been doing some media and research into it. It's just been announced that China has reopened their market to Brazilian beef. They have been shut to the product for over 2 years due to the BSE ban recently. What kind of impact will this have for Australia is still hard to determine because on one hand, Brazil had already sent a lot of product to Hong Kong, which is if you like, a proxy or a backdoor into the China market. So we may either see additional product going into China and Hong Kong, or we may see a resultant fall in Brazilian exports to Hong Kong and an increase in China. But, part of our success into this market in the last 18 months has certainly been, it's only been Australia and New Zealand with access, through to China directly, whereas other markets like Brazil and the US have had to ship it in through other countries. So we expect to take some impact there from Brazil, but to what volume, we're not quite sure yet. But it's certainly been a very welcome market for Australian producers, this Chinese market. We expect to see some decline in shipments in 2015, but certainly that's not a demand issue. That is very much a supply issue from the Australian side. The EU, another market that is growing steadily, and certainly this is a great representation of what can happen when you get improvements in market access. We now, for a few years, have had access into the global grain-fed beef quota into the EU. It's about 48,000 tonnes, and as part of that, we have been able to supply more chilled product into that market, the most valuable market for beef that there is for Australian exporters, and we've seen exports consistently growing over that time. Even though we expect to see a significant decline in slaughter and production in 2015, we think this EU market will continue to take more product, largely due to the increased number of Australian producers who are becoming accredited and the focus being put on this market for higher value grain-fed product. Just touching on a few other situations that really weighed heavily into our mid-year update. This financial situation for a lot of producers is understood to be very dire, and we are looking at some issues there. But certainly when we're looking at a very tight supply prospects in the year ahead, on the other hand, you've got the consideration of the very tight and urgent need for sustained cash flow from a lot of producers. But average farm cash incomes, whether you're a northern or southern producer in recent years, has been quite low, with debt levels increasing. But when we look at what producers, and everyone would have heard recently of what the US market's doing or what Brazilian cattle prices are doing, and you've got to look at that in terms of one, the effect on their industry and why prices are so high in those other markets, but also it has to be acknowledged that Australian cattle prices have fallen below the pack, if you like, or fallen behind the herd. US choice fed steer prices have nearly increased 30% year on year. Brazilian steer prices 20%. And Australian steer prices look for 13, 14 to only been up about 7 to 8%. But again, that's off a low base, so that's nothing to really cry about. So when we look at what global prices have done, we certainly see there's a lot of catch up to be done. And again, it brings me back to that first point that I made, that really we've fallen behind just from the sheer weight of cattle that have been entering the market over the last 24 months. The main slide, one that I'd like to really leave you with, is that cattle prices, we have some catching up to do. So this is Australian trade steer prices against US feeder steer prices. Traditionally, and this slide only goes back from 98, but I can take this back to the 80s and 70s, traditionally they follow each other very closely. There's a range of reasons for that, but it's our largest competitor, it's also one of our largest markets, and the US really does set the benchmark for where cattle prices are going. But as you can see in the last 2.5, 3 years, there's been a significant disconnect between what US cattle prices are getting and what Australian cattle prices are getting. And again, the reason for that couldn't be in more contrast. For Australia, it's been supply and drought. For the US, it's a very low cattle herd, 60-year low cattle herd, but also their demand situation has improved domestically. And at the moment, we're seeing reports that consumers are actually being able to absorb some of these higher prices that are coming through. But certainly we think, you have a look at those lines there, we think the Australian cattle price has a lot of catching up to the US fed steer price, and not the other way around. We don't expect US prices to be dropping down anytime soon, given their very tight supply issues. But for me, and when we did our projections here, I think the big one that looms for a lot of cattle producers in the eastern states is this El Nino forecast. It's the big unknown. You know, from a recent presentation that I saw, they're now talking about it kicking in late spring. But, you know, for those in the south who have had an excellent autumn and wet winter, you know, runoff into dams is still limited, and that has to create concern for when temperatures get warmer. And for those in northern New South Wales and Queensland, it brings very little welcome news in that conditions are still very tough and deteriorating. So when we looked at this El Nino, you know, it still continues to see supply remain high into the end of the year. And really we're left with two scenarios for the longer term outlook. Hopefully, the better scenario is we get widespread rain through drought regions over the, you know, starting with a wet season. That'll see producers retaining numbers and start to rebuild, and we see a long-term internal rebuild. The second scenario, and the less palatable, is we enter what could be viewed as very much the US scenario at the moment, where we just continue to have drought, we continue to increase slaughter rates, our herd continues to fall, and we just have less cattle to slaughter anyway, and prices respond likewise. But you know, that just leaves you a bigger and bigger hole to climb out of eventually to rebuild numbers when you eventually see improved conditions. But I've probably spent far too much time looking at El Nino forecasts over the last 3 months, but I think it's the big factor that looms very heavy over the next second half of 2014. So knowing that I'm pushing my 20 minutes, and apologies for any who have heard mumbled or broken up audio on this, wrapping up, you know, the past 2 years has really been a big supply surge. Interestingly, when we go back and have a look over the last 30 years, we have seen periods like this before, but really it's been just such a significant turn-off with very limited restocker demand that's really had the big impact on prices. And as we know in Australia, rain makes all the difference, and that's what we really hope we get back to a stage of. Demand has been and is expected to remain very strong for both beef and live cattle. Even with the news today of Brazil back into China, overall global demand for beef is very strong and reflected in record high global beef prices at the moment. But the big point to make with that very strong demand is what kind of production volumes is Australia going to have? Of course, we've had high death rates in the last 2 years. We've had poor brandings, which means the amount of calves coming through the market over the next 2 years will be very limited, and we have less cows that's coming from. So we're tipping a significant sustained supply shortage looming over the next 2 years. So really, I finish with the one, and I think Rob will be able to take this further. The question isn't if there'll be a significant price rise and shortage of cattle, it's when it'll commence, and then what that price response will be over time. I think that's yours, Rob.
Thanks, Tim. I'm just going to build a bit on what Tim said because, you know, the basics of what Tim has outlined there has been pretty much in line with our forecasts and predictions over the last few weeks, and I guess the mid-year update was more confirmation of where we thought the market was going to go. So I'll have a look at some supply fundamentals, and the US is important, and I just want to expand a little bit on that, and Tim's already given us a fair bit. Global cattle and beef prices, are we really lagging behind, and by how much? And I'll build on that. Export prices and domestic markets, the correlations and expectations we can see from that, and then what's the upside potential for the UIC and other cattle categories. On the supply, as Tim's mentioned, it's really been a story of two markets. And the reason the US is important is, as Tim said, it's now not only our biggest customer, but it's also an export competitor. So what happens there does directly impact us. Their herd has been falling, and their slaughter of cows has been falling as well as the herd's fallen. In contrast, you can see on the right-hand side of that slide, our female slaughter has been, you know, very strong and very sustained over this recent period. It's contributed a lot of extra beef onto the market, but we don't think that's sustainable. And it's interesting, a comment made the other day was that the Australia will replicate the US herd rebuild phase in 2015, given normal and average seasonal conditions. Steer slaughter is a similar trend, but less intense changes. But you can see on the US steer slaughter chart that their slaughter numbers have been steadily falling year on year as their herd's fallen. On the other hand, we've just been slaughtering as much as we possibly can. And we'll give you a few more pointers as to why that's been happening and what the encouraging points have been for that. Talking about prices, it's a frustration, and I note Angus's article a couple of weeks ago on Mecardo saying, the world prices are up, but we're missing out. This is just expanding a little bit more on that. The US cattle prices are being driven to those record highs by tight supply, but also very, very robust demand, and that's a good thing for us, even though we haven't quite got there yet. The other thing is that the 90CL and the EYCI relationships have really got out of whack. So to give it a little bit of background, the 90CL is a significant product that we export a lot of into the US, and you can see that has followed the US price upwards, but our EYCI hasn't been dragged up. Tim touched on it briefly before, and that's mainly been driven by the fact that the EYCI has really lagged any strong restocker demand over this recent period of dryness. And the grey area on that slide is just the difference between the two prices. And you can see now we're sitting at, I think it's almost 200-cent discount, or the EYCI is almost a 200-cent discount to the 90CL, whereas in previous times and in more normal seasons, for example 2011, our price for cattle, the EYCI, which is a reflection of the sale yard prices, fluctuates to plus and minus the EYCI, the 90CL price. So it's the other thing about that, I guess, is that the 90CL price is hitting new records. We know, and I think we've got some domestic consumers online today. It's painful for domestic consumers as well, because they're now having to compete with the export price to buy their own product here, and at the same time seeing low cattle prices. That's not going to change for them, but that demand and that strong 90CL price is a strong pointer to what we can see ahead for our cattle price. Interestingly, the previous spikes were in 2001, where we had 500 cents, 500 cents a kilogram for our 90CL into the as an export frozen cow. That's been exceeded now, and we've hardly seen it come below 400 cents since 2009. The other thing that's happened is that the spreads, and we quite often talk about spreads because we think once you understand the spreads or basis differences, then you can understand where strengths in markets are. The spread at the moment is, and you can see on the left-hand slide of that slide on Figure 1, is that the EYCI up to this drought was tracking around about zero, above and beyond, plus 50, minus 50. And then in this last period, the 90CL, with its rapid rise, has pushed the EYCI to a big discount. Highly unusual, that level. The same thing with cow prices. Cows, and this is worth remembering for our summary at the end, cow prices, which generally trade very close to the, and track very closely with CL prices, they've really been hammered because of that, the increasing price for CLs, but the dramatically improved supply that we saw coming onto the market. We think that what all this tells us is that we're quite confident those price relationships will return to normal in the last quarter of this year and certainly into 2015. Talking about looking at underpriced and overpriced, one of the ways that Augusto has built this model for us, which is an EYCI and a price model. Now, in the price model are things like grain prices, 90CL export prices, any extra circumstances such as droughts and BSE outbreaks, etc. And you can see that in the last 2 years, the model and the actual EYCI, the model's in the grey line and the actual EYCI in the green line, have really diverged. And if you look on the right-hand side, we can see at times when it diverges, usually coincide with droughts in Australia. So the previous droughts are highlighted there by the orange circles, and you can see following a drought, there's quite a strong rally. Now, part of our prediction, and the reason the EYCI model in the grey line in Figure 1 is so high, is because our prediction is saying that the next, the recovery out of this drought will result in the market moving back up to those levels. So the recovery to the EYCI is going to come mainly from improved demand for restocker and those lighter unfinished cattle that really get belted in a drought with lack of demand. Just looking forward, I know we're not making any prediction about whether an El Nino is going to come or not, but when we had a look back at what happens in the past El Ninos, it can perhaps help us understand what might happen in the future and make some predictions. So on that, in Figure 1, the top grey line is what happens in a normal season. So the market from July until Christmas, it battles away through August, September. It slips a little bit through October, November when the big turn-off comes, and then flattens out in December. In El Nino years, on average, is the lighter grey line down the bottom, and you can see that from October on, it generally really falls away. Now, doesn't happen every year, because as you can see there in 1997, the El Nino effect, or the El Nino in the weather pattern, didn't have any effect on the market. However, the big effect came in 2006 and 2009, and you can see the market falls away pretty strongly into December as, those areas of southern Queensland and northern New South Wales and into southern New South Wales that get badly affected have to just dump their cattle. The good news is, after this, is that we have strong rallies, and the rallies are on the right. Post El Nino, there were strong rallies coming out of in 2003, 2007 and 2010. It's interesting that if we think if there is an El Nino this year, it'll be far more restricted on the effect on the market than what we've seen in the past. And there's two reasons for that. One is that the expectations are for a somewhat mild El Nino, so it won't be perhaps as ferocious as we've seen in the past. And we've also got markets already depressed and demand fundamentals very strong. So we've had a big sell-off in this last year. We've got the market fairly depressed and demand fundamentals very strong. So the downside potential in that result should only be around about 10% to see the EYCI testing around the 300 cent support level. Now, I emphasise that this is if there's an El Nino. If that eventuation comes through and we do see the markets soften back through the spring with the northern New South Wales and those areas that are affected having to put more cattle onto the market, the recovery into 2015 could well be even stronger than the levels we've seen in the past. So for those in the southern areas who are going well now, it may be the sort of year where an El Nino comes through, you still end up with feed, you aren't forced to sell off, and you can wait out until the market comes out of its El Nino dip into the latter half of the year, and the rally we expect will be quite strong. If this is the other thing that came out of the MLA projections, which I thought was some good new information. If we face another El Nino or another failed wet season in the north, supply will not contract 11% in 2015 as MLA suggested, based on the return on seasonal conditions. So we think supply will be forced. Slaughterings will still fall by up to 5%, but they won't be as dramatic. Now, what that'll do is it'll supply the market for the latter half of this year and early into next year, but the following recovery may turn out to be even stronger and better supported than what we saw in 2013 and 2014. The other thing that gives us a lot of confidence about the market is that we're currently seeing the discounts for prices relative to the EYCI giving us a pointer as to what's likely to recover the most. So Figure 1 is the national cow discount of the EYCI, and you can see in that the long-term average is the grey broken line. Last year we had the green line, and this year cows have gone to almost record discounts to the rest of the market as people have supplied into the market and the sell-offs continued. That tells us that if we're going to see a general market rally, then the type of animal that's most likely to move the most will be the cows, because they will go back up into more their normal spreads, and we'll see them to give you an indication of numbers. Just turning my page here. Target price upside is expected to exceed 50 to 60% for the cow indicator. So that puts a target price of between 350 and 400 cents for late 2014 and early 2015. Once again, that's contingent on having a good wet season break in the north. So currently we're at about 240 cents for cows, for the national cow indicator. That's a really strong upward movement. If you look at the steer, though, you can see the heavy steer, which is a finished and fat animal. It's been trading at quite a strong premium for the last 2 years to the EYCI. And all that's saying is that the demand for finished and butcher beef or export beef has been strong, while the EYCI has been weak, which is giving that heavy steer spread, an unusual look, a very strong look. Now, they've been tracking at a premium to the EYCI, and it's been based on the tight supply and robust export demand. But once conditions return to normal, they'll probably underperform the store cattle markets and move back to normal discounts to the EYCI. So you can see that normally those finished steers operate at sort of somewhere between par with the EYCI and slightly below. Given that the EYCI is going to rally quite strongly, though, that still means that target prices for this type of animal is in the 400 to 420 cents a range, and currently they're sitting at 360. So to finish off, we can get some pointers from the Western Australia, which is interesting given they only have a small herd, but we can see what happens when, if we look at New South Wales and Queensland, where the big numbers have been coming through, their state cow prices have been the lowest performers. Western Australia's been higher, and the heavy steer prices are showing a similar story. So to conclude my presentation, it's a really positive outlook, which is always makes you nervous when you're in agriculture, because we know that there's always something that comes along. But it's the fact is that demand, which is always the main driver of prices, that will dominate, and it's very strong. If supply is El Nino affected, it will only delay the rally. In fact, it could cause the eventuality to be even more pronounced than what we're expecting right now. As I said, the most improved will be cows, because supply will fall, and they're at a big discount now, and restock of cattle, because demand will improve. And then this will push up the EYCI, causing all classes to benefit from falling supply. So that's about the summary for what I've got to talk about. If we want to hand back to Jenny Ann, and she can coordinate some questions, I think.
Yes, I've just let everybody know if they've got any questions, would they mind just putting them through their chat box. We've got a pretty good opportunity for Tim and to ask Tim and Rob anything that you might have come across while you were listening to them. So I'll just give you a couple of minutes to put some through. I've just got a question about what does SWT mean. It's shipped weight. It's a measure of the weight of the meat that's exported. I've just had another question about are the slides available for download. We've been recording the webinar, both the audio and the slides, so I'll be sending that out to all of you when it becomes available to us. So once again, apologies for the audio. As Tim said, it's very much a learning exercise for us, so I hope the later part of the webinar has been good. Another question that I've got, probably directed to Tim, does the EU only take heavy grain-fed beef?
I'm assuming I'm not on mute or anything, Jenny Ann, you can hear me?
Yes.
Yeah, look, and I wouldn't call heavy grain-fed beef. I'd call it, it's a very well-finished animal. But really that's under the access of the 48,500 tonnes of grain-fed quota. We do have access to the European market on what's called the Hilton quota, which is a very limited 7,700 tonnes, something around that figure, which we fill every year because it's a very lucrative market. But look, predominantly what we send there is what I would call very top quality beef that primarily comes out of grain finished operations. So yeah, on the whole, the predominant exports is a grain fed or grass finished product of a heavier animal, and quite often you see all of the carcass in a variety of cuts go to that market because it is EU accredited and they can get a premium for that product.
Thank you, Tim. I've got another question this time. How big, and it's probably directed to Tim again, how big do you think the effect of the China-Brazil deal, what effect will that have on the Australian-China trade?
Yeah, really good question. And in the back of the envelope figures at the moment, I would say that it will have a small impact because I think what we could see is some of the product that Brazil was initially sending to Hong Kong being directed straight into China. It's worth noting, though, that whilst they've just, the access has been announced, there's only 8 processing plants in Brazil at the moment that is China accredited. So there's still a lot of work from the Brazilian side of things to be able to, if you like, ramp up their volumes to meet that market. As opposed to Australia, we have 33 plants that are accredited to send beef to that market. So, you also have a look at the extent of the growth of that Chinese imported beef market over the last 2 years. And if that was to continue, we could very well see Brazil sending very large shipments in there like Australia does and really, that market absorbing it and Australia still keeping China as a very large market for beef.
Thanks, Tim. Rob, I've got a question for you. I don't know whether we've got an answer for this now, but I'll direct it to you. I've got a question of how much upside in cow price in Victoria, as the store cow prices are quite good.
Yeah, it's a good question. I think the story about cow prices is, if you look at the report last week, the cow indicator for Victoria was at 286. The only one higher was Western Australia at 307. But the average for the national indicator was 240, and in fact Queensland and New South Wales were below 250. So I guess what we're doing here, we're looking at taking a bigger picture, not so much a localised picture. I think what it tells us, though, is that and especially in the south of Victoria, you've got some strong meatworks that kill a lot of cows. There's a great incentive for these abattoirs to continue to keep supplying these markets. The margins that they've been able to make in the last 12 months would have been record margins for a meatworks, and that's good because it means they're cashed up and they've developed markets and they've now got to supply those markets. So they're going to step into the market as supply falls and tightens with continued demand. So, look, I think if we're looking at a 240, you want to know how much we think it's going to go up? We think if we're looking at a 240 price now, maybe somewhere between 350 and 400 for late this year, given that the spring does usually result in a few more cows come off and certainly early 15. That's our estimation. And just on the EYCI, I thought it was really telling that MLA came out with a figure of 450. When you look at it, I mean, 450 is a record. I think I had a look today. The previous highs are about 415 or 420 or something. So for someone like MLA to come out with that, there has to be a very, very strong underpinning of the fundamentals, and it's supported by our models and supported by our anecdotal evidence, but it's really a strong outlook. And when we talk about sheep, and we've got a strong outlook for sheep and lamb as well, we're really in one of those sweet spots. So it's watch it closely, because I know for sure that MLA would have looked very, very carefully before coming out with these bullish outlooks, just as we do. But this is a great time to be a cattle producer, I think, with apologies to our consumer customers who are on the line.
I might just add to that, Rob. We don't actually forecast price, so we mightn't have said 450, but we certainly said there's up to 40% improvement in the market when the supply tightens.
It was just as well you got that disclaimer in there, Tim, because I might have misquoted you.
I've got a question for Tim. from one of the people online. Looking at the Japanese market, how are the high US prices affecting that market? Shouldn't we improve our access with more affordable beef?
Yeah, look, don't forget that what the US exports, the type of cuts they export, one, they have a very large volume of it, and two, it's as most exports, it's surplus to their domestic requirements. So it's cuts that really don't receive the value that they should do or could otherwise do in their domestic market. But what we've seen just in the last few months, with the very high beef price in the US, we're starting to see those volumes, the US ships to all markets, tighten back. As the US market attracts more product. Probably what we've seen also in Japan was we saw a big surge in US product this time last year when they decreased the access on the 30-month age limit. But also what the US has going for them, just on the flip side of our very high dollar, is the US dollar is weak and low at the moment. So they have the added advantage there, not only of the economies of scale of being able to supply the favoured cuts into markets, particularly Japan. They also have a weak dollar, which helps them there.
Just on the US market, Rob, this is a question for you. How long till the US herd is back to a normal level, and what effect will that have on our supply to the US?
Look, it's a very good question. I think we probably need to take that on notice to some degree, and it would be a good research article for Mecardo to look at over the next few weeks, because at the moment there's a lot of anecdotal evidence that the fight for acres, if you like, is being lost by cattle. So other enterprises are stronger, mainly cropping. But that said, there is a lot of country that is well suited to cattle. So I think we're seeing, if we look at the US cow slaughter, you're seeing the slaughter rates drop away, which would be also support us anecdotally that they're trying to rebuild the herd. But once again, they're coming off, I think, Tim might be able to help me out here, I think they're coming off a record low cow herd, and the lower you get, like we see with our sheep flock here, the lower you get, the harder it is to build numbers. And with this strong demand, and if you think of it from a producer's point of view, strong demand and strong prices is going to keep you incentivised to keep selling to some degree, but on the one hand, you're going to want to build numbers. So it's going to be a balancing act, I think.
I might just add to that, Rob, a very interesting one I heard from a presenter from the US 2 weeks ago was that the US, compared to, I think it was 20 years ago, the US cattle slaughter number has fallen 34%. Their beef production has fallen 4%. So don't underestimate the ability of the US industry to just get them bigger and bigger again, which they proved in recent years. And that's where there's a very interesting debate, and it's probably not for this webinar, about the use of the Zilmaxes and all that, which is very prominent in the US at the moment.
Thanks, Tim. Got some questions around restocking and the restocking and the cattle breeding herd, and it's off the back of the likelihood of higher prices. And the question basically is, won't this motivate farmers to take full advantage of the higher prices down the track? Should they start restocking now? And there's been a couple of questions about whether they should be going back into cattle breeding because the ability to restock trade steers down the track will be more challenging. Tim, have you got any comments on that?
Yeah, look, it's going to be a very, very hard balance between the lure of what could be potentially, much more favourable prices and the desire, if seasonal conditions, to enable them to actually rebuild herds. I'd probably rather throw that one to Rob on, specific advice for what producers could do there.
Yeah, I think there's one simple result, and that will be that the supermarkets in the last couple of years who have had access to a lot of heifers that have gone into feedlots to be finished off and met their demand, those animals won't be available in the same numbers because restockers will either try to buy them, or herds will keep more heifers to build them up themselves. So the feedlots are going to come under a bit of pressure. Backgrounders are going to find it more difficult because once again people will try and hold back some cattle. It waxes and wanes a bit where the big margins are, but we're now going to go into a period, I think, where the breeder is going to be the king again for a while. because you've got to have that animal to start with to either take advantage of a market or sell into a market opportunity like we've seen there. I think that's, I'm just seeing a note from Angus here that that's really something good that we could look at for next week in one of our reports as to what we expect is going to happen with herd rebuilding. But it's going to be very awkward because if we went into if Queensland happened to have a good summer rainfall, then, you know, that area, our evidence or our experience is that when prices are good, people want to rebuild the herd. So not only do you have strong demand from people wanting to buy the beef to kill, you have strong demand from people wanting to breed it up. But if you're not in cattle at the moment, you can't take advantage of it in the next 12 months, but there will be a lot of incentive for people to try to get back in and build that herd.
Thanks, Rob. We've probably got just time for one more question so that we can finish on the hour. Is there an understanding of domestic consumer retail price resistance, given that the domestic market will be under supply pressure? Tim, can you perhaps try and cover that?
Yeah, look, I will. And, you know, I think the domestic market gets underplayed sometimes because it is our largest market and by far our most valuable market for beef. And it's, if you like, not only on our doorstep, it's got no currency issues. What we've seen for retail prices over the last 3.5 years is no movement in the average retail price for beef. Now, this is a price that's collected, has some debate around it, but effectively it's the beef price that is collected by the ABS and used in the quarterly CPI inflation figures. I think, and my conversations I've had with a domestic market, is that they are expecting a tighter supply of beef to put significant pressure through that retail price. And it probably leads me to the one that we haven't really touched on a bit, was what if the dollar goes lower? If the dollar goes lower, it even works further against the domestic market. And I noticed there was just a question there about forecasts for the Aussie dollar. There was a very good survey by the Fin Review of 20 economists, and then they asked some school students and different things on a dartboard. But most of them had the dollar as at middle of the next year, sort of between 80 and 85 cents. Now, if we see that, that just strengthens an export conditions and plays against the domestic market. In terms of resistance in the domestic market for prices, I think beef will be more sensitive than some of the other red meats because it is already the most expensive, and it will be tied to what consumer sentiment and the domestic economy is doing. But if we go back to 2010, 2011, where we saw lamb prices increase 10% year on year, we saw a significant contraction in domestic demand for lamb because it just became too expensive, particularly at food service. So, you know, it's probably more of an interesting warning and to note. But, you know, if export markets are attracting more of the production with a dollar at 95 cents, you know, if the dollar only goes lower, that's going to make it harder for the domestic market to compete for product.
Okay, thank you, Tim. Look, unfortunately, that's about all we've got time for today. Thanks very much for participating in our webinar. I hope you found it valuable. I'm just going to open up a quick survey on the right of your screen, and I just would really appreciate it if you took a minute or so just to answer the questions. As I said, we're just keen to make sure we improve this as much as we can, this survey will really help us do that. Just while you're all finishing that, on the left-hand side of that, you'll also see my email address. So if you've got any other feedback that you think of after the event, please feel free to email me. Any of you that are not currently Mecardo subscribers will receive a 3-month free trial to Mecardo, and I'll send you your login details either later today or tomorrow. And if you have found this useful and you're interested in attending a similar one on sheep meat, we are going to be holding a sheep meat webinar. Tim will be participating again following MLA's sheep meat projections release. and it'll be Tuesday the 5th of August, so just over a fortnight, again at 1 o'clock. So please email me if you'd like more information on this.
Jenny, could we also just acknowledge and thank Tim for his time? We really appreciate our support from MLA, and it's been fantastic, I think.
Absolutely. Wouldn't be able to do what we do without MLA, so thanks, Tim.
No, that's all right. We might have had some sound problems before, but I heard that one come through loud and clear.
So that's about all for today. So once you've done your survey, you're welcome to close up. Thank you very much.